And again, thanks for joining us today. We sure appreciate it. We've got a lengthy list of registrants that are joining us here today. Many of them are clients of Boer Insurance Group. Those of you that work with us, we sure appreciate it. Thanks for your trust. Thanks for your friendship. Thanks for being here with us today and for your support of our business and of our team. We don't take that lightly, and we sure appreciate you. For those of us, or for those of you that are here joining us today that are not clients of Boer Insurance Group, we appreciate you too. Thanks for joining us. We hope you find this helpful and useful, no matter who it is that you work with for managing your insurance. And of course, if there's anything that Boer Insurance Group can do for you, now or down the line, that is what we are here for. So we are always happy to help, and we've got a great team behind us that is always glad to jump in. So what are we doing here today? The title of our webcast here today is 6 Things You Need to Know Before 2024. That's about as creative as 3 Boers could be when trying to design the title for a workshop. But what we're going to hit on is kind of where are we at, right? We held a workshop in person in the fall of 2022. Kind of said, hey, here's where we think things are going. Here's what we're expecting in 2023. It was a little bit bearish. Unfortunately, much of what we expected was true. Wish we would have been wrong and wished we would have missed the mark in several spots. Unfortunately, that wasn't necessarily the case. Mostly dumb luck, not that we did anything right or our crystal ball was perfect, but we want to touch on kind of where is everything at now that 2023 is starting to come to a close, and what are we expecting as the calendar rolls to 2024? When do we get out of this insurance mess? When do things start to ease up a little bit? Where do we go from here, and how can we help get our insurance plans in the best shape that they can be in, given the state of the insurance environment right now? I know what you're thinking, what am I going to possibly learn from a couple of 14-year-old boys? I get that, but that's why Dave is here. Dave has 40 years of insurance experience crammed into his 38 years of age. So he's going to be here as our subject matter expert as needed. With that, let's get this thing rolling. The agenda for today. 6 parts here. We're going to touch on first managing your premiums, right? It's on the top of everybody's mind. It's all over your news feed. It's all over the internet. Everyone's sick of hearing about it, right? Everyone knew insurance costs were going up in 2023. How do we manage our premiums? Where they're at today and where they're going in the future? What do we need to do to be in the best shape we can? Practice smart claim management.
And yes, everybody should be aware that we will see if you drop off after that first topic. So in hindsight, we should have left that as the kicker at the end to hold people's attention. But yes, we will know if you're only here to figure out how to lower your insurance costs. So
yep, so you can save the magic wand for the end, of course. Practice smart claims management. This is something that has shifted dramatically in the insurance world, even with our advice to our clients. We're going to touch on what to expect there and how that is changing. Number 3, remember your umbrella. Now is not the time to skimp on your umbrella insurance policy. Number 4, construction costs. That's still on everybody's mind. Yes, we're seeing things kind of level out a little bit, but studies still show that there's a very alarming trend of homes being underinsured. Number 5, know what ownership really means. This is an important area to make sure that you understand who is on the title or on the deed and how is something being insured. It's not necessarily a choice. It's more dictated by ownership. So what does that mean? And are my assets insured correctly? Finally, number 6, don't skip on PIP. That is awfully creative and awfully cute. Obviously, a board didn't come up with that one, but that's important, right? You still hear about the changes to Michigan's auto insurance law from 2020. Yes, they're still having an impact. Yes, there are still some things being sorted out. But 99 out of 100 people should not be rolling the dice and skipping or eliminating their personal injury protection coverage. With that, Derek, you're going to get us rolling on point number 1, managing your insurance premiums. Beyond just getting out that magic wand and whipping that thing at your computer, what's happening? Number 1, where are we at? And then after that, let's touch on what should we do, right? What should people be considering as the insurance market is changing and things are hardening up? What do we do from here, and how has that changed from the past? So tell us what's happening. How have we gotten to where we are?
Yeah, that's a great point. Without going too in depth into the various factors that drive insurance rates, I think it's easy to just look at kind of what's happened over the last 2 or 3 years, right? Um, Auto insurance claims have increased substantially. Not only has the cost of the average claim increased, but the frequency of claims have increased as well. I think anybody that's driven on the East Beltline or the S curve anytime recently has seen driving behaviors deteriorate or continue to deteriorate. I think that's been the trend for the last decade probably, and I don't know if that's ever going to reverse its course. So the claim frequency has been increasing and the cost of the average claim has increased. Why is that the case? Well, 5 years ago, when someone's refrigerator leaked and damaged the wood floor, it might have cost $6,000 to tear out the old one and put down a new one. Today, that exact same claim costs $15,000 because the cost of the materials, the cost of the labor, all of the subcontracting expenses, the average cost of that claim has gone up, especially from a homeowner's perspective. Now, I know what you're thinking, but my vehicle gets older every year, right? So why doesn't my auto insurance cost decrease? Well, realistically, only about 40 to 45% of an auto insurance premium is based on coverage for damage to the vehicle itself. The rest of it is medical expenses, it's lawsuit protection for an injury, it's uninsured motorist, it's mini tort coverage, it's rental reimbursement expenses. These things are all based on the cost of lawsuits, lawyer expenses, medical expenses, hospital bills, rental cars, all that stuff today rather than a year ago or the year before that. So the majority of the cost of an auto insurance policy is going to increase each year because a lot of it is not related to the value of that vehicle. However, even the component of the auto insurance policy that's related to the value of a vehicle has increased over the last few years. Why? Well, we all know that used car prices have traditionally decreased each year, and that's not been the case over the last few years. So if a vehicle is totaled, the insurance payment has generally increased each year with that vehicle. Also, if the vehicle is not totaled, which 90% of auto insurance claims result in a vehicle not being totaled, the insurance policy and the insurance company is on the hook for repairing that vehicle. Well, a front bumper might have cost $1,100 last year. This year, it costs $1,400. The cost to install that front bumper last year might have been $45 an hour. This year, it's $65 an hour. The cost to paint that bumper was $85 an hour last year. It's $105 per hour this year. So even though the overall vehicle might have depreciated a little bit from one year to another, most auto insurance claims do not result in a total loss. Instead, it's a repair cost, and the cost to repair a vehicle increases each year, even if the overall value of that vehicle might have decreased, which would be kind of the standard that we saw prior to COVID and the pre-pandemic used car craziness that we've had. So
Sure. And
that's really
what's
what's driving that.
Yeah, and what that is causing, right? Those are all the reasons behind the financial results that you're seeing from insurance companies over the past 2 years. Dave, tell us what we saw from a combined ratio in 2022 and where they're projecting that to be in 2023 and why that matters to anyone.
Well, for the industry, I think it was about 112%, which means that for every dollar of premium an insurance company took in, they paid out $112, excuse me, $1.12 between claims payments and operating costs. So for every dollar premium they took in, they actually lost 12 cents. And when you take in, billions of dollars of premium or millions, hundreds of millions, that adds up to a lot of loss. And with the rate increases that they've been taking and the tighter underwriting that they've been implementing, that will eventually even itself out. They will get back to profitability. Projections I've read say that 2024 is probably going to be another year of inflated insurance premiums until insurance companies get back to even, and then you may see the market turn where they loosen underwriting and premiums will either flatten out if inflation is not bad, or they may actually come down.
Perfect.
So is that what makes getting insurance somewhat challenging these days? We've dealt with a lot of prospects that are saying, hey, I'm trying to get insurance quotes. I want to talk with this company or that company. And that company just is not open to do business. They're not looking at bringing on new clients. They might shut down their new business department entirely. Is that because they know that every policy that they bring on, they're going to lose, 12% of the cost of that premium because they're going to pay out $1.12 for every dollar that they bring in?
Exactly. Yeah, and they have to keep certain ratios of premium to surplus. They have to have enough money in reserve based on financial regulation to stay in compliance with the laws that govern insurance companies. And they're very heavily regulated. So if they don't stay within those ratios of having enough money in reserve to pay not only the normal claims, but a really extenuating claim circumstances where they have claims that exceed what they ever would have expected. They have to have money in reserve so that consumers, policyholders, and regulators know that they're going to be good for that and not go bankrupt and leave some claims unpaid. If they don't meet those ratios, the regulators start knocking on the door, and sometimes they take over. They go into receivership if things get really bad. So they have to increase premiums to generate profits, to increase reserves, so that they stay in compliance with those ratios.
Sure, sure. And so what this all means to us as consumers, of course, is we're all paying more for insurance in 2023 than we did in 2022. Spoiler alert, we're going to pay more in 2024 than we did in 2023. Even so, insurance companies are losing money and are going backwards. Do we feel bad for them? Of course not. We don't care. But it's important to just understand why that is happening, right? It's easy to look at the insurance premium and think, holy smokes, I'm paying 22% more. Must be nice to pad the, the pocketbook at the insurance company. They're not. They're all losing money. They're still losing money. That's going to happen again in 2024. It's just the nature of the beast and where we're at. So we want to be transparent about that, provide the reasons behind it. It all comes down to the numbers. Claim payments going out the door are exceeding premiums coming in the front door. It's not you. It's not your insurance company. It's happening across the board in the industry.
An industry expert made a comment that insurance is less expensive than it's ever been. Are you paying less? No. But for that dollar of premium that you're paying in, the insurance company is giving $1.12 back. Normally, they would expect to give 93 cents back, right? So the bang for your buck factor in the insurance world is actually the best it's ever been, as hard as that might be to believe.
Yeah, tell that to my budget. Thank you.
Yeah. Let's move on, Brian.
What should you do, Derek? Give us kind of your quick hitter of what should we do about that, right? We do see rising insurance cost across the board. Do we just bite the bullet and suck it up, or what? What should we do going forward here as we're looking at our insurance plans?
Well, you hear insurance companies talking maintenance policy a lot, right? And they say it's not a maintenance policy. When you've got that $1,300 claim or that $2,100 claim, that insurance company is not all that excited to have to assign an adjuster to that claim, to review the repair estimate, to issue a supplemental payment, to do all the administrative work that's associated with these, $1,000 or $2,000 or $3,000 claims, right? So what I think is important is for people to focus on what's really going to change my year or my life, right? And to make insurance decisions based on that larger picture rather than saying, hey, if this goes wrong, am I going to have a bad day or maybe a bad week? Yeah. Do I need to insure against that? I don't know. I think we need to accept the fact that when something happens, we might be a little bit upset or a little bit disappointed for that day or that week or even that month. But if it's not going to completely blow our family's budget for the year and it's not going to ruin the rest of our lives, we might be better off just self-insuring that and saying, if it goes wrong, I'm going to handle it myself. My insurance policy is designed to protect me from having a really bad year that potentially devastates my entire financial future and therefore my life. So I think we need to look at what is it that we're most susceptible to when it comes to destroying our entire financial plan and our financial health and making our insurance decisions based on that. And that kind of leads me into the next point here, deductible management, right? If I'm not going to be filing a claim for $1,000 or $2,000 or $3,000, why do I have a $500 deductible on my homeowner's policy? If my agent's going to tell me that it's probably not wise to file that $2,200 claim, well, a $500 deductible is kind of silly then, right? If I'm only going to be filing a substantial claim from a kitchen fire or hail damage that destroys the entire roof, I can probably stomach a $2,500 deductible or a $5,000 deductible, which is going to entirely eliminate the temptation to file that small claim that, might feel good to file, but would end up shooting me and my family's insurance premiums in the foot going forward.
Sure. And we as insurance agents, we're all human, right? No insurance agent loves to tell a client, hey, yeah, you could file that claim. I just want to be clear, it's probably not in your best interest to do that. And it's not our call. It's not your insurance agent's call on whether you should or shouldn't file a claim. If you want to file a claim, file that claim. But as your insurance agent is providing that advice about what should you expect going forward, and are you coming out ahead or behind when you file that claim, that's an important conversation. So your insurance agent does not like to have that conversation with you. They don't want to provide that feedback. Nobody wants to hear it, but they're providing that up front to try to help you make the best decision that you can for managing your insurance plan over the long term, right? Derek, you say work on your credit score here. What on earth does my credit score have to do with my insurance plan?
Yeah, that's a very good question. It was a dirty little secret in the insurance world. It's become much more apparent today, but insurance companies use someone's credit score very heavily when determining how much to charge that person for their home and auto insurance. A higher credit score pays less. A lower credit score pays more. Whether that's fair or not, we're not going to dive into those details. The state of Michigan allows it, and every insurance company, with exception of the one noted here, Cure, which I think is over on the east side of the state, it uses a credit score for the pricing of their insurance policies. Believe it or not, statistics have shown that that's the number one factor in determining how likely someone is to have a claim in the future. Credit score is more predictive than someone's driving record, the zip code they live in, their age, anything else like that. So insurance companies, of course, want to price insurance appropriately based on that specific person. So they're going to use what's most predictive as heavily as possible. The state of Michigan limits how much they can use it to some extent, but each insurance company uses it basically to the maximum that the state of Michigan allows. So in managing your insurance premiums and keeping your insurance budget in check, the most important thing that anybody can do is keep a good credit score. How do you do that? Brian, I was told earlier this year, and it was somewhat surprising to me, that your credit score is going to look at every single one of your credit cards and look at, number one, your total credit and how much you have available and how much you use, but it's also going to look at every single one of those credit cards that you have. Obviously, we are not, financial advisors, we're not credit counselors or anything like that, but it was surprising to me to know that I might have this, really high credit limit when I combine all my cards, but I just like to use that one card that gives me all those great points, and I might run it up to 50 or 70 or 90% of the allowable balance. But overall, I've got all these other cards in my back pocket that I could use if needed. Credit companies look at that and they do not like that. That's going to have a very negative impact on your credit score. So when I stopped doing that, my credit score actually went from a 350 all the way up to a 420. So things got a lot better for me and my family when I found that out.
Very good. That is helpful. And the beautiful thing, I suppose, about the fact that the state of Michigan has and is likely always going to allow credit scoring is most of our clients are in West Michigan. Most of them have above average credit. It's favorable from an insurance standpoint for almost everybody that's on this call right here. And if you have any questions about what Derek has hit on there, or if you have questions that come up on any of the other content that we're going to hit on within this workshop, there's a Q&A feature in this presentation. It's going to be down at the bottom of your screen. You can type any questions or comments that you have, and Derek, Brian, or Dave will hit on those answers as we walk along through the content that we've prepared today. So, Derek, this follow-up page to what you just talked about is more about who you're working with, right? And again, most of us on this call are clients of Boer Insurance Group. Of course, we appreciate you trusting us and being with us very, very much. For those of you that don't, if you're working with an independent agency, that's someone like Boer Insurance Group. What that means as an independent agency is that your insurance agency does not work specifically with one insurance company, right? A State Farm or an Allstate or a Farm Bureau, those agents work only with that one insurance company. When you call that agency, that is who you get, right? If you work with an independent agency, that agency has different insurance companies behind the scenes that they work with, where they might have some clients with this insurance company, some with that, some with this other one, to help identify which option makes the most sense for each client based on their own goals and based on their own situation. So yes, they're all different. Yes, they have some nuances from one to the next. Yes, they price their policies different and their coverage and their claims practices are going to be slightly different. So we think it's important to work with an independent agency so that you have someone on your side that has a better view of the market and can help identify which option out there makes the most sense for you, and then help you keep tabs on that over the long term. Because sometimes a pivot is necessary, either because of changes in the insurance market or changes in your insurance profile for your family. Next, smart claims management. And we've hit on this a little bit as we've already talked through some of these comments. It's a claim or not a claim, right? This is what it comes down to. And the challenging thing on your insurance agent's side is that, even 2 years ago, we would tell clients, you know what, hey, you're only going to see maybe a 10 or a 12% premium increase by filing that claim. That increase only applies for 3 years. You're going to net $900 on that claim. I would do it. I think let's you're paying for the coverage anyway. Let's take advantage of it and put some money back in your pocket and feel good. That script has changed, right? And we've had to learn that, because the surcharge for claims for policies that have had claims in the past has grown substantially. So we need to think twice, and we need to think a lot harder before we file a claim on an insurance policy. And it's not only the existing company that pays the claim that's going to apply that surcharge. If we try to look to move that insurance policy to a different insurance company, they're looking at that same claims data, and they're probably going to view that claim even more harshly than the existing insurance company. So it really limits options down the road if we do need to pivot that insurance plan to a new insurance company. So your insurance agent has no skin in the game. They do not want to encourage you to not file claims. That's not putting money in their pocket, but they're trying to help you understand, what is the impact going to be, whether you like it or not? What's the impact? What should we expect? And is this a claim that we want to file on our insurance plan? And at the end of the day, it's your call. If it's a silly claim that you shouldn't be filing, but you want to file it anyway and feel like you got some money out of your insurance, by all means, that is your call, and you can certainly do that. But your insurance agent will help you understand, what is the impact expected to be and how can we best navigate this.
Brian, one example of that, the second line here, consider the way other companies might treat something. Like you had mentioned just a few moments ago, if you have accident forgiveness on your auto insurance policy, where you can cause an accident and your insurance company is not going to put a surcharge on your policy, well, you still want to consider, is this worth filing? If it's only a $1,300 or $1,500 or $1,700 claim, do you want that on your insurance record? Because if you file that claim, your existing company might not surcharge you for it. But if that company's rates go absolutely through the roof, now when you're looking to move to a different company, every other company is going to consider that at-fault accident, right? So the company that you were using that forgave that at-fault accident has you handcuffed, because yeah, they're looking the other way, but every other insurance company isn't. And now they know that they've got you in a corner, and you're going to be handcuffed to that insurance company for quite some time afterwards. So I think it is important to just kind of take that general claims approach when you're managing your insurance, because it's hard to say, especially in the current insurance environment, how long you'll be with that particular insurance company.
Sure. Side comment, Derek, are you a fan of paying for accident forgiveness on your auto insurance policy?
No, I am not. I think you're prepaying for an accident that would happen or expected to happen at some point in the future. If I had a horrible 16-year-old driver, maybe I would. But I think in general, most people are not big fans of paying for accident forgiveness, because you're basically just taking that accident surcharge and you're spreading it out among a few years of paying for that forgiveness coverage on your policy. So overall, no, not a huge fan of it.
I think most of us would bet on ourselves, right? Most of us think that we are better drivers than average. So why would I pay ahead for forgiveness for an at-fault claim that I certainly don't plan on causing anyway, right? Next point here, remember your umbrella. We're going to kick it over to Dave for just a moment of commentary here, because Dave has seen thousands of umbrella insurance policies. in his career, and he has the experience and has seen, unfortunately, the claim side of things enough to know how important an umbrella insurance policy is. Dave, what's your kind of 60-second commentary or summary of why an umbrella policy is still as important today in 2023 as it was in the past, and why everybody should be considering that piece of their insurance plan?
Well, good point, Brian. An umbrella policy, for people that don't know, is an excess liability policy that covers you for an additional amount of lawsuit protection above the coverage you have on your homeowner's policy for personal liability, as well as your auto policy. And if you have boats, or you have rental properties, or you have snowmobiles, it also gives you an excess layer of liability coverage above those. And you can buy it in increments of $1 million to $10 million. And if you look at the cost per $1 million of coverage, it's super reasonable. It's probably the best buy in insurance. And that's partly because it's unlikely to be used, because it takes a really big lawsuit to exceed the limits of coverage you have on the underlying policies. And so it's not used very often, but it sure is great peace of mind when you go to bed at night, knowing that your assets are protected for anywhere from 1 million to 10 million on top of your base layers of liability coverage, which typically max out at about $1 million. So the worst case scenario I think of is we've all been at a stop sign at a main road or at a red light and thinking about turning right, and see a bunch of cars coming along, and it looks like one of them's going to turn right onto your street. So you pull out, and hiding behind that car was a motorcycle with 1 or 2 people on it. And if you pull out in front of that motorcycle, bad things are going to happen. You're going to have a large lawsuit against you. The liability on your auto policy may be wiped out in that claim. And then you would turn to the umbrella liability policy for whatever limits you have available there. And both policies, the underlying liability and the umbrella policy, provide defense costs. So they hire the attorneys to defend you in that lawsuit, and then they pay on top of that up to your limit of liability coverage on the underlying and the umbrella policy. So, we've also had some claims where there were bad boat accidents. Somebody hit somebody that was swimming or who fell off an inner tube. The boat doubled back and didn't see them. It resulted in death. It was a large lawsuit. The biggest lawsuits are probably auto related, but there's a lot of other ways that these policies can be used or called into action. And so society has become more litigious over time, and with inflation, judgments go up. And our no-fault law changed, as you know, in 2020 with no-fault reform, and it made the potential for being sued by another driver that much more than it used to be. So we're all exposed to more litigation than we were in the past. So these are still a very good idea.
So Dave and Brian, let's just kind of go off the cuff here, and let's each name one thing, and we'll just keep going until we exhaust them for reasons why someone would want to have an umbrella policy. And I'll start this off. They've got a pool with a diving board.
They own a dog.
I was going to do the dog, right? They got a boat.
They have a rental property.
They have a roof that needs a contractor to get up on the roof.
They have teenage drivers.
They have a motorcycle and they put a passenger on the rear of it.
They have a driveway that they don't necessarily shovel and ice or shovel and de-ice all the time, and ends up with a slippery front walkway.
And maybe the biggest one is they have assets that they don't want to lose and future income that they don't want to lose.
Exactly. So when Dave said that, that person is protecting their assets, not only are they protecting their assets with that umbrella policy, they're also protecting their future income. Someone like Brian and myself, who have 30 years of a career left, we don't have the $1 million of assets, but we do have 30 years of earnings ahead of us. And if there's a large lawsuit against us that's not covered by our auto or homeowners policy in its entirety, without an umbrella policy, in Michigan, a judge can take our earnings until we've paid off the remainder of that lawsuit. Instead, we've both opted to have that umbrella policy to settle the remainder of that lawsuit so that our paycheck goes entirely into our wife's pockets.
Can I add one more reason?
Go for it.
So typically, an auto policy stops at the borders of the United States and Canada. So if you drive overseas and you're renting a car and you have a car accident, your auto insurance policy does not cover that liability lawsuit. but an umbrella policy typically extends worldwide for auto liability. So you would have coverage on your umbrella policy if you have one.
Yep,
Great point.
that's another good point. Yep, that's a great comment. Yeah, well, that was helpful. I think the key point to take away from the comments on the umbrella policy is it's incredibly inexpensive. As I look at our attendees on this call, most of us on the call have probably a $1 or $2 million umbrella policy, and the premium is probably between $160 and $350 per year for, again, $1 million or even $2 million of coverage. That is a drop in the bucket for most people in their budget. And again, unlikely to ever need this policy. We sure hope that you don't, because if you ever need to make a claim on an umbrella policy, something went terribly wrong. But if you ever do, like Dave said when we started, it is the best bang for your buck, and we certainly are proponents for it. Construction costs. Everyone knows that the Boers can barely change a light bulb. Dave will be coming into the office after this call because we've got to change a light bulb back there, and I think we need to put a screw in the door. Derek and Brian are still trying to figure that out. So we don't know a whole lot of.
That'll be more work than Dave's done all week.
There you go.
But that to say, the Boers don't know a thing about construction costs, but we do have access to software that the insurance industry has designed to help estimate what it would cost to rebuild a home brand new in today's construction market. Now, are we those type of agents that think that that number down to the penny is God's word of what it would cost to rebuild a home? Absolutely not. But we use it as an anchor point, right? So you take a home built in 1984. It's 2,200 square feet. It's a frame home. It's got a 2-stall attached garage, 2.5 baths, below ground basement, 50% finished, semi custom construction. That's going to spit out a number of $493,000 for the cost to rebuild that home today. But is that absolutely spot on? Of course not. Maybe it costs $550, maybe it costs $430, but that's a good anchor point for that conversation. When it comes down to it, what you want to know and what you want to do when you look at your home insurance policy is look at the coverage. It's going to have an A next to it, the letter A, and it's going to say dwelling. After that, it's going to show a coverage limit. That's the amount that your insurance policy would pay up to rebuild your home in today's construction environment. Knock on wood, and thank God, we don't see a ton of total loss home insurance claims. We have seen them. Dave has seen plenty in his career, but that is when you are concerned about that number. Holy smokes, the home is a total loss, and we've got to rebuild that home brand new. It's important also to keep in mind that the debris removal and the cleanup costs are part of that coverage amount, which generally is going to be 6, 7, or 8% of that coverage amount is going to be poof, gone, just simply by getting rid of the debris and then prepping the site for that rebuild. So you know your home best. You know what you've put into the home or what's been done to the home. Just keep in mind when you look at your home insurance policy that that coverage limit is the coverage amount that's on the table to rebuild the home brand new in today's construction environment, if God forbid a fire or a tornado took it all the way down to the ground.
Now, Brian, are you saying that I don't just go on Zillow and see what the market value of my home is and choose that for the coverage amount on my homeowner's policy? Is that not how it works?
You do that, Derek, but that's because you don't understand how home insurance works.
I don't do that for my clients, though. That's only for my own policy.
That's fair. No, Zillow is showing the market value of your home. And could that be correlated, or is that similar to the reconstruction value of your home? Yeah, it very well could be, but there's no reason that it needs to be correlated, right? You could have a enormous, old, worn down home that's only worth 200 grand. But if you had to rebuild that home today because it's 4,200 square feet, it might cost 800 grand. On the flip side of that, maybe you own a small cabin on the shores of Torch Lake or any other desirable lake in Michigan. Market value might be 1.5 million, but your home insurance might only show 220,000 because it's an 800 square foot cabin. You could rebuild that for 220,000. So no, we use Zillow as an anchor point, but that's for obtaining square footage data, year built, getting some photos of the home. When it comes to the market value, it really is unrelated to the construction or the rebuild value of your home.
I understand now. Thank you.
Very good.
Brian, so what happens, just real quickly, I noticed something on that prior page that said guaranteed replacement cost, because I think this is something that has been on a lot of people's minds over the last 2 or 3 years. Now, let's say that I had a home that had $300,000 of coverage on it, and my policy renewed in February of 2020, and it burned down in June of 2020. We all know what happened to the world between that time frame. That coverage of 300 grand was probably not sufficient based on very, very limited availability of materials, very, very limited availability of labor, and all the other hurdles about getting the materials to the site and then the house actually being rebuilt. It probably realistically would have cost $400,000 or $500,000 to rebuild that home just because it happened to be destroyed at the most inopportune time possible. What happens? Because the coverage amount on that policy is established at the beginning of the policy period, and it remains for the entire year of that policy until it renews. So tell me what guaranteed replacement cost is and how that would help in that instance.
Sure. Yeah, guaranteed replacement cost essentially says that the insurance company is on the hook to rebuild your home brand new to the specifics of the home as it was just before it went down in that fire, regardless of what it costs. Right? There are some stipulations, right? It has to be insured to an amount that they agree is reasonable. And you can't then go add a $300,000 addition and think that you're still adequately covered. But let's assume you're not making any major improvements to your home. If you've got guaranteed replacement cost coverage on your policy, as long as you allow the insurance company to adjust that coverage figure by their inflation calculation, when that place goes down in a fire, they're going to pay whatever it costs to rebuild that home brand new. You don't have a limit to that coverage amount because you've essentially shifted that obligation over to the insurance company. I personally did not care so much for that coverage up until 2020. I thought it was a little bit silly and kind of unnecessary. I've had to flip my attitude because I think that that can, in some instances, be an incredibly valuable coverage today.
Same here, same here. It basically alleviates the concern about, another global shutdown causing construction rates to go absolutely through the roof and your house burning down at a very inopportune time. So thanks for that additional information, Brian. What
Certainly.
ownership really means? I think this is very important today, probably more so than it's ever been. You'll note here, at least the first bullet point, the insurance world follows the legal titling of assets. When I say something is my car, do I actually own it? Am I the legal owner of that car? It's my house. Is the house legally deeded to me? Those types of documents, the title, the deed, the different agreements, those are what's going to determine who is the legal owner of that item and who therefore is responsible for insuring it. When you say it's so-and-so's car or it's so-and-so's house, that doesn't necessarily mean that that person is legally the owner of it and therefore able to insure it. The titling and the deeding of vehicles and homes needs to follow the actual person that's calling it their item, and that person needs to be the one responsible for insuring it. Brian, some additional input?
No, I think that summarizes it, right? It's not insured if it's not insured by the right person, right? Can't insure a car that you don't own. Can't insure a home that you don't own. It's not a choice. You might be paying for coverage. You might have a policy that's got your name and that asset on it. But at the end of the day, when the rubber meets the road, if that asset is not insured by the appropriate person or the appropriate entity, it's not actually being insured. It's
two really quick examples for the group here. Number one, grandma's insuring her niece's vehicle because it's too expensive for her niece to insure it on her own policy. Grandma's doing a really nice thing, put it on grandma's policy, insured that vehicle. No, if it's owned by a niece and the niece, lives a couple miles away, that vehicle cannot be insured on grandma's policy. That needs to be insured by the niece as the owner of the vehicle, living in a separate household, et cetera, et cetera. Other example, the deed of a home has been moved from Brian and Kristen Boer into the Brian and Kristen Boer Revocable Trust. That trust is now the legal owner of that home, and the homeowner's policy needs to reflect the trust as the legal owner of the home. And it depends on which insurance company you're using, but it can be shown in a variety of different ways. It just needs to be made aware to the insurance agent so they can update the homeowner's policy accordingly.
Yep. It's not like the family, cell phone plan where Derek and Paige and Brian and Kristen and every other person that might somehow be related is all on Dave's cell phone plan. It doesn't work like that in the insurance world. It's not a choice. It's not an option. It's dictated legally. So make sure that your assets are insured correctly.
And it's also not the same as the health insurance world. We all know in health insurance, the children can stay on the parent's plan, I think in most cases until they're age 26, regardless of whether they live in the household, regardless of whether they're married or not. That's not the case in auto insurance or homeowners insurance. Has nothing correlated to that. Age doesn't matter. That's not the same concept when it comes to your auto and homeowners insurance.
Yep.
Don't skip on PIP. Brian, this is
Yes.
important as well.
This is important as well. And this is our last thing that we're going to hit on here. So as we're talking through this, please use the Q&A feature at the bottom of your screen to submit any of the questions or the comments that you've had as we've walked through some of this content here. We'll make sure that we hit on those just after this final point on PIP coverage. PIP, what is it? Personal injury protection. Personal injury protection coverage, what is that? It's a coverage in your auto insurance policy. For shorthand, we call it medical coverage in the auto insurance. People think about it as being involved in a car accident. Yes, that's true, but it also applies if you're a pedestrian who is hit by a car, or maybe on your bicycle and hit by a car. Unfortunately, a lot of personal injury protection claims are in a similar example like that. You might not be in a vehicle, but holy smokes, you were hit by a vehicle. That is a personal injury protection claim. So this coverage applies. It doesn't matter who was at fault or how it happened. If a vehicle was involved and you were injured, this coverage follows you. This is your coverage. It applies to you. It follows you in your vehicle when you're a pedestrian, when you're renting a vehicle in Florida, when you're in a taxi in Chicago, when you're out east riding along with your brother's vehicle. This coverage follows you. It is your personal injury protection coverage. I want to kick it over to Dave just for a 60-second kind of commentary. We've hit this, we've beaten this, pretty hard ever since the law changed in 2020. We were doing a lot of prep before that, advising on how this coverage works, what the new coverage options are. If you just have 30 seconds, Dave, to say, what do we need to know about PIP and what should people be choosing? How would you describe that? What do we suggest in almost all scenarios?
Well, there's a lot of options now that we didn't used to have. It used to be that everybody, prior to the no-fault reform, everybody who had a car insurance policy in Michigan had unlimited personal injury protection coverage for the medical expenses. It was mandatory. You had no choice. That's what you had. To give you an example of that, we have a client who was injured while riding his bike. He was a 12-year-old boy back in, I think it was 1980 something, and he was disabled beyond belief. He requires around-the-clock care. He's still living. And his claim is up to about $9 million under this coverage. So it's a very valuable coverage, and it pays for around-the-clock care if necessary, custodial care, medical care, all that type of stuff. And we were given the option to eliminate it entirely from our auto insurance policy if we have Medicare or Medicaid. We can drop it down to $50,000. And if you don't qualify for either one of those, which we would never actually recommend because there's major differences in the coverage between Medicare and personal injury protection, you could drop it down to $500,000 or $250,000 and reduce your premium somewhat. It's not some substantial savings, but you're giving up a lot of coverage because one of the main things that personal injury protection covers that many medical policies don't cover is that custodial care. So you're in a nursing home or you're in an assisted living facility because you can no longer take care of yourself. Your health insurance doesn't cover those expenses, which are $70, $80, $90, $100,000 a year, but your personal injury protection does cover that if it's because you were hurt in a car accident.
Yep.
So we recommend unlimited for just about every scenario.
Yeah. That's a great summary. That's a great comment. I think what you need to remember is that when your know-it-all uncle or your neighbor that is always on the online forums, when they tell you that you don't need that coverage in your auto insurance because you have health insurance or because you have Medicare, the important thing to know is that's not the case. There's very little overlap. There's only about 33 or 34% overlap in terms of what gets paid by health insurance or Medicare versus what gets paid by personal injury protection, which is exactly those type of long-term care and skilled nursing expense type of payments that Dave mentioned, which God forbid you ever hurt so bad that you need those. But if you are, and you're one of those people that just want to say, I want to know that I'm covered. I want to know I've got the appropriate coverage. You need to keep that coverage at unlimited. That's what most people have done. Probably 96% of our clients have unlimited coverage in their auto insurance. No, you're not an outlier if you kept that coverage the way it was. That was what almost every insurance agent suggests, and that's certainly what we suggest as well. So with that, if you're just waking up, what did we hit on today? What are the key points here? Determine your risk tolerance and insure accordingly, right? Like Derek said initially, you need to focus on the big ticket items. Sometimes, water backup coverage or insuring my golf clubs, or what did I do with my firearms? Those things probably aren't going to change your life. And if they're not, it's probably not worth focusing on them. Focus on the coverage amount on your home, focus on your liability exposures, focus on your umbrella insurance policy. 2, file claims wisely. We hit on that. We'll continue to hit on that. We're here for that, right? If you forget everything else, just call your insurance agent before you file a claim. At least let them tell you what to expect and whether they would suggest filing that claim or not. It's your call. Fire away with that claim if you'd like, but understand what is in your best interest and what is not in terms of filing claims. The umbrella policy, we touched on that. Dave hit on that with a nice summary of why that policy is so important. Your home coverage, we talked about that, right? Take a look at the dwelling room. I was going to say dwelling coverage on your policy. How much coverage is there? That is the coverage for rebuilding your home brand new. It's expensive to do that today. Keep that in mind. Confirm the titles and the deeds. Are the assets being insured appropriately and by the appropriate person? It's not a choice. It's dictated legally. Needs to be insured by the person who owns legally that item. And then finally, ensure you've got unlimited PIP on your auto insurance policy. That's what almost everybody out there should do. That's what almost everybody does. But if you're hearing to the contrary, have that conversation with your insurance agent. If you need to peel some premium, you're interested in what differences are out there, that's great. That's certainly your call, but just know that it doesn't move the needle that much. And having unlimited PIP is a very, very, very nice safeguard if, God forbid, the worst happens on the road. With that, we're going to hit on some Q&A. We have a couple questions that were raised here. We're going to touch on those in just a moment. Before we do that, thank you for joining us today. We sure appreciate it. Those of you on the call that work with Boer Insurance Group, a lot of you that I see as attendees, you've been with us forever. We appreciate your loyalty. We appreciate your trust. We appreciate the opportunity to just get to know you and help manage things for the long term, to be there for you when something goes wrong, and to help make sure that things are as smooth as possible going forward. For those of you that joined us that don't work with Boer Insurance Group, thanks also for being with us today. We're glad to have you here. Talk with your insurance agent, talk with Boer Insurance Group, talk with anybody out there, get the info that you need and make the right decision. We're happy to help if and when the time is right. So the Q&A, first one that rang in, it's my understanding that my credit score may drop if I don't borrow, i.e. no mortgage, credit cards are paid off, etc. How does this affect my premiums? Great question. Bad answer. It does not help the premiums because eventually your credit is going to start to dry up. What you'll find, kind of credit counselors and other people, what they suggest, hey, great, no mortgage. I mean, you've done it all right, right? The silly thing is you've set yourself up perfectly. You don't need credit. That is a huge pat on the back. You've been disciplined probably for many, many years. What a lot of credit counselors suggest is keep one credit card still open, the one that you've had for the longest, and make a couple purchases each month and just pay it off the same way you've always done at the end of the month. That at least keeps your credit active and you can still maintain a high credit score, despite the fact that you probably don't have an auto loan. You, of course, don't have a mortgage. You're not using debt, but it's playing the game. It seems like a silly answer, but there are some situations where you've got to just play the game. Playing the game would be keeping at least one credit card open, the longest one that you've had, and making a purchase or two each month. Next, should boat insurance be incorporated into a homeowner's policy or should it be on a separate policy? Derek, what do you think about that? There are two ways. There's no wrong answer here, but what's your take on it?
I had a feeling you were going to throw this one at me. You can let me answer the credit card question.
I'll answer the boat question.
I think if I'm speaking at a conference and this question comes up, I'm going to say insure the boat separately on its own policy for two reasons. Number one, if there's a claim on the boat, it's not going to impact the entire homeowner's policy and the policy's claim-free discount. Number two, most policies that are specific to boat insurance, they're going to have some additional or some ancillary coverages on there that are probably not available on the homeowner's policy. Some of those might be towing for the boat if it breaks down, you know, in the middle of Lake Michigan, some fuel spill expense coverage, some of these things that just are not typically available on a homeowner's policy. So that being said, I think it really depends on the type of boat. Is it a small fishing boat with an outboard motor? Not too concerned about that. Is it a 45-foot cabin cruiser? Yeah, that's going to be more appropriate on its own boat insurance policy. But you know, truth be told, if we looked across our book of business, I would say more boats are insured on a homeowner's policy than on a boat insurance policy because it's generally less expensive to put it on the homeowner's policy. It's just a little bit easier, not only for the client, but for the agent as well, because it just goes right on that existing policy. You don't have to set up a different billing account, have new policy documents, obtain signatures, do all that fun stuff. So no right answer, but if I had to answer one in front of a big group of people like this, I would say put the boat on its own policy. There's just a few advantages to doing that.
Yeah, I agree with that. I think the simplicity and just knowing that it's likely not going to cancel for non-pay or fall through the cracks somewhere if it is on the home insurance policy. I personally, that's the thing that I think is most beneficial is it's unlikely to get lost or forgotten about and not be paid, coverage lapses, that kind of thing. Like it can sometimes if it's on its own, it can be a little bit overlooked. So yeah, there's no right way to do that. I think it depends on kind of the entire insurance position and how feasible it is to insure the boat on that home insurance policy, like you said, Derek. Another question that rang in is about credit score. What is a good credit score to aim for to get the best insurance premium? No specific answer, but the higher, the better. I would say when you're in that mid 700s, you're starting to get benefit. I'd say if you're under 700 and you're in the sixes, it is probably hurting you a little bit. If you can get over 800, you're starting to hit the sweet spot. A lot of insurance companies are in that kind of top tier, and you're going to start to really see benefit on the insurance side as that score climbs higher and higher. So there's really no kind of, hey, get to this figure right here, but the higher the better. And if you're in the sixes, get to the sevens. If you're in the sevens and you can get to the mid sevens or upper sevens, that's really starting to kind of crank things up in your benefit. If you can bust over 800, you're really going to see the impact on your insurance premiums going forward, at least in my experience. Derek, do you disagree at all?
No, I don't. The higher the better. And I think once you hit that upper tier, it opens up so many options for you. Almost every insurance company is going to pursue that top tier credit client pretty aggressively. So not only are you just saying, hey, which insurance company is going to be most competitive? You're saying every insurance company is competitive. Which one do I want to use? Which one has the best claims rating, the most coverage available, the ease of doing business with apps and payment options, et cetera, et cetera. That makes insurance a lot more fun rather than saying, you know what, I'm going to pick the one that, you know, I can afford. Being able to afford all of them and choose the one that really is the best option for you makes it a lot easier to stomach your insurance bills. That's for sure.
That's a great point. That's a great point. Well, hey, that wraps it up for the Q&A. So thank you again for everyone joining us today. We sure appreciate it. Thanks for working with Boer Insurance Group. Thanks for carving out some of your time today over the lunch hour. We appreciate you. Anytime we can help, whether that's just, you know, help with a glass claim all the way to planning for what comes next year or where the umbrella policy needs to be, that's what we're here for. We're proud to have the team that we have. We're proud to have the clients we have. And we are here to serve you. So thank you for working with us. Thank you for trusting us. Have a great holiday season as everything moves forward to 2024. And we look forward to connecting with you in the new year as well. Thanks again for joining us.
Thanks, everyone.
Thanks, everybody. Great to see you guys.